You're listening to Macro Sunday, hosted by Andreas Steno. Happy Sunday and welcome to the Macro Sunday podcast. My name is Andreas Steno. I'm the founder and CEO of Steno Research, your independent macro research shop. And I'm joined by Emil Müller.
Yep. Hi.
Our head of research for this podcast. And we're joined by Michael Kao in 10 minutes time to discuss everything related to the Chinese yuan.
Yeah.
Michael is a former Goldman trader, but also the chief investment officer of Acanthos Capital. So both a strong career on the sell side and on the buy side, and with a strong knowledge on China. And obviously, Emil, everything has been about China this week.
Yeah. Oh, we're scarcely talking about anything else, really.
Yeah. that is the short version.
Yeah.
Remember that this is the independent macro podcast out there, and towards the end of the show, we try to become as concrete as we can by giving you an insight into our 100% transparent portfolio.
Yeah.
And we probably need to disclaim, especially this week, that our trade ideas might be
sometimes maybe good, sometimes maybe shit.
Sometimes maybe shit.
Yeah.
Isn't that
in the rubble.
Yeah. But Emil, you're obviously following the trends in emerging markets and China in particular at this juncture.
Yeah.
Before we get to the structural discussion on China, we'll take the discussion on the short-term outlook with Michael and on the exchange rate, etc. I'd like to show a clip from a Donald Trump rally just after COVID-19.
Did anybody see my speech the other night on Saturday night? Yeah. So, what I said the other night, there's never been anything where they have so many names. I could give you 19 or 20 names for that, right? It's got all different names. Wuhan. Wuhan was catching on. Coronavirus, right? Kung flu, yeah. Kung flu. COVID-19, COVID.
Kung flu, I think that's the best version of it. Emil, the reason why I wanted to play this soundbite in this video clip is that it may be fair to say that the Chinese economy is simply suffering from long COVID.
Yeah, in different aspects, right? So on one hand, they haven't really supported consumers, right? Even though they locked everyone down and let them out again, they didn't have that much excess saving to go spending on. That's one side of the story. Another side of the story is that the industrial complex hasn't really been catching on to the extent that we sort of expected, at least on my own account here. I thought they would come out on all guns blazing and really start to be offensive, as you know, the manufacturing really has caught tailwinds across the globe, and really like a short space of time from when COVID ended, if you like. So yeah, they and now they're in a balance sheet recession. That's basically my take on it. They're in real trouble due to the entire real estate complex.
Yeah, I mean, I had a look at some vacancy data from large Chinese cities.
Yeah,
I think it was 27 million square meters of vacant apartments in Beijing right now.
Yeah,
and that is up 10 million square meters in just a few years, right? Thereabout. And almost one-way traffic right now.
Yeah.
What can they do about this situation, Emil, if we look at it on a structural basis?
Well, the problem is structural, and the only solutions they have are, temporary liquidity measures, basically. Unless they want to, on one hand, ease the pain, they will also add fuel to the fire. That's the problem, and that's why I think they're largely jawboning and they can't really find a footing, and all the policy measures they keep adapting are essentially just incoherent, right? Cutting rates on one hand and intervening to defend the yuan on the other.
Yeah.
Yeah, that's so. Essentially, I think what they really have to do is at least to to find a floor for the real estate sector and really back it.
Yeah.
And that's easier said than done. But right now, everyone's operating under the assumption that their real estate, their apartment, is going to decline in price in future, and that's just a deflationary debt spiral, essentially. So, yeah, plenty of trouble.
Indeed. And we still see an ongoing deleveraging in households.
Yeah.
In sharp contrast to the manufacturing sector, as you
Yeah,
mentioned.
that's what they're picking up, right? There are
Yeah.
plenty of incentive schemes to keep up the trade surplus.
Mm.
But yeah, and now that's the demand on that side is starting to catch some headwinds.
So I mean, with that, say 10-20 year
Yeah.
horizon, any reasons to be long China at all?
Not really.
No.
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 I mean, and especially if you're invested in some illiquid asset, real estate, of course, being the obvious one, but being some private equity or something, phew, you're in trouble.
Yeah.
Yeah.
Buy Hongxi.
Yeah.
But that is the
Yeah.
sole sort of
Yeah.
glimpse of light at the end of the tunnel that I can see.
Yeah,
At
absolutely.
least we see pretty decent acceleration in the export of passenger cars.
Yeah.
And impressively, Germany is not even
No.
delivering one single subcomponent to these EVs from
No.
China. It doesn't seem like it.
No,
At least.
I think
I'm not an
the
expert,
only
but-
thing that sort of has me question whether that's my negligence of China going forward is they really know how to implement industrial policy.
Mm.
They have an actual track record in recent decades, unlike most, unlike the US and the Eurozone in particular, right?
Yeah.
But right now, if you buy a car, I don't know if you've been EV hunting, but I've been looking a bit these past weeks, and you can't really come up with any qualitative reason as to why you should pick a Western EV. It's
relative to a Hongxi.
yeah.
Okay.
I mean, it's more expensive. It doesn't have as much hardware, and it's just technologically behind. I mean, and you pay a lot
Except
more
for
for
the
it.
Tesla, maybe.
Yeah.
Yeah.
Yeah. You could argue. But
Yeah.
they're not that big usually. So
No.
if you have 3 kids or 2,
Yeah.
2 as I do, and the third one coming up, So yeah.
Yeah.
Yeah. That's where I'm
I still prefer driving German gasoline cars, and I'm not sure I am able to stick with that view for for the rest of my life. But let's see.
Yeah.
For now, I mean, it's just much more reliable, isn't it?
Yeah. No doubt.
I'm a boomer in that sense. Emil,
Mm.
let's invite Michael Kao to join us here at the Macro Sunday podcast.
Yeah.
Michael is actively involved in commodity trading, but also actively involved in assessing the Chinese yuan trends.
Mm.
And I think it's very, very critical whether that 730 handle in dollar yuan holds here.
Yeah.
We've had a
Great.
few tests of it already, but it seems like the authorities have sort of managed to contain the pressures for now, at least.
Yeah.
But will they be able to defy gravity? Let's bring on Michael Kao to discuss that. And as per usual, we introduce our guest of the week with a piece of music.
Yeah.
And since we're talking about the Chinese yuan, why don't we listen to a small propaganda soundbite called Red Sun in the Sky.
天上太阳红呀红彤彤哎，心中的太阳是毛泽东哎，他领导我们的解放哎，人民翻身当家做主人。
It is now our great pleasure to introduce Michael Kao to Macro Sunday, former Goldman Sachs, Acanthus Capital Management, and now Kao Family Office. Michael, it's great to see you. Thank you for joining us.
Yeah, thanks for having me again.
Michael, we are recording hot on the heels of a week with a lot of focus on China. And if we watch the most recent price action in the dollar versus the yuan, it seems like there's sort of a talk of war going around that 730 handle. So what do you make of that level and the importance of that level for global markets?
Yeah, I've been beating on this drum for a while, as you probably know. During the regional banking crisis in March, I wrote a thread called "Ball in a China Shop," meaning the U.S. dollar wrecking ball, and that at that point, I think the yuan exchange rate was around like 685 or something like that. And I said, look, I think China's got real economic problems. You know, back in at the end of last year, I basically said that the reopening 1.0 was likely to be a dud. But now, what's interesting is that lately there were hopes of like a second sort of reopening, and that's not only proved to be a dud, it's gone the other way. Like the breadth of the China economic collapse is actually kind of mind-boggling. So, anyways, that seems to have come to the forefront now. But I posted back in March that I felt that between all of the hidden debt on China's balance sheet and its very, very different response to COVID, coupled with all of its longer-term structural demographic problems, would at some point come to a head and prove very, very deflationary for the world. And so here we are. We're at the essentially October of 22 lows in the yuan. And to answer your question, I do believe this 735 level is a very crucial psychological level. I've actually become a little bit cautious here. In the name of full disclosure, I've been short the yuan from around 688 to around 725. I missed this last little leg up because I think that as we approach this, what I'll call the intervention zone, I think chances are that the PBOC is going to defend this level to prevent the negative psychology of a disorderly devaluation from taking hold. That said, when I made that swap and I tweeted about it, I said that I think the interesting way to continue with the tail hedge is to go into the Hong Kong dollar, because to me, at the end of the day, in a tail situation, the two are inextricably joined at the hip. The Hong Kong dollar, as you know, has been hard pegged to a band of 775 and 785 for 40 years. But it's a very anachronistic peg. And about a month ago, you saw that the overnight HIBOR, which is their equivalent of Fed funds essentially, got jacked up to 5 3/4 to basically stave off speculators from betting against the peg. Interestingly, in the last week or 2 weeks, you've seen that overnight HIBOR back all the way down to 3 1/4, right? So I don't know exactly what that means, whether it means that, they are relaxing their defense on that side because they got issues with defending the Chinese yuan, or maybe it's because look, we all know the issues with Country Garden on the back of Evergrande a couple of years ago, and it's the Scylla Charybdis analogy that I've been writing about is the one where, if China has a strong yuan, it is very defeatist for them trying to revive their export-driven economy, and if they have a weak yuan as a result of monetary stimulus, which is necessary to resuscitate their property sector, it potentially causes them other issues like commodity price inflation, right? Since they're importing about 85% of their oil, which is dollar denominated. But the reason why I felt that they would err towards the weaker yuan a couple of months ago was that you saw oil's collapse earlier this year. I felt that all things being equal, the Scylla monster of weaker yuan would seem that much more palatable, right, to the PBOC. Now we're at this crucial juncture. So, I think they're still very much in a quandary. I feel that the PBOC and HKMA are, what you're seeing right now is a little bit of deer in the headlights. They tried to intervene when the yuan hit around 722. They intervened very, very aggressively, if you remember, and took it down to 711. And then now it's gone up to like 735. There's a little bit of a deer in the headlights mentality, but I feel like they need to prevent a disorderly situation from happening if they can. And so that's the key question. But again, it's only going to be a Band-Aid, because for them to really revitalize their economy, they need to stimulate. And the conundrum that China is facing is the same conundrum that a lot of central banks around the world are facing, which is everybody is hoping upon hope that the Fed is going to finally blink and stop its hiking cycle, or at least start to ease, right? But the problem facing the entire world, and especially China, is the strength of the U.S. consumer. The strength of the U.S. consumer just doesn't seem to let up, and therefore it doesn't allow the Fed to let up. And so anything stimulative that China does is going to inherently weaken its currency. So they're fighting a losing battle here, in my opinion.
Is it even possible for the People's Bank of China to sort of defy gravity for the yuan here? If we look at rate spreads, for example, Michael, we're back to 2007 spreads between dollar and yuan rates. And back at the time, we traded above 7.75 in dollar yuan. So are they fighting an impossible battle here?
It's pretty. I mean, look, I wrote a thread, I don't know, about a month ago. I called it the Ivan Drago Fed, in a callback to Rocky IV. You might be too young to remember that movie, but if you remember, right, there's this huge Russian guy goes to Rocky, I must break you. So to me, right, that's the Fed. The Fed is Ivan Drago, and it's basically saying to the world or to the U.S. labor market, I must break you. I think the Fed, because of the strength of the U.S. consumer, one of two things is going to break, or both. Either the U.S. labor market or a more economically frail economy like China that's heavily, heavily indebted. And we're seeing it happen in real time in China already. But I tweeted out this morning, I said, let the outdoving of the Fed begin, because Asia never stopped outdoving, right? With between Japan and China. You're now seeing Latin America start to cry uncle and start to slash rates. And I actually think that perhaps the next shoe to fall in terms of outdoving is going to be the ECB. I'm curious what you think of that, given where you're situated. What do you think of that?
I think that's a very fair assumption.
Yeah.
We've had the discussion internally here whether the deflation that we see in China will actually spill over to a large extent to the European inflation basket relative to the US. And I think that's a feasible assumption by now. Also, given that trade ties between the US and China, at least direct trade ties, have faded quite materially over the past 3 years. If you look at the percent of goods imported from China relative to the rest of the world, I think we're down to 13%.
Something like that.
They're about in the US now from more than 20 just a few years ago. I know that some of these trade flows are redirected via Brazil, Mexico, etc.
Mexico in particular.
Yeah, to avoid tariffs. But in any case, the goods deflation is not as crystal clear in the US as it would have been a few years back. Michael, the oil market is obviously an important source of volatility in the yuan as well, it seems, at this juncture.
Yeah.
And when you look at the oil price development over the past, say, 6 or 8 weeks, relative to this malaise in Chinese economic activity, what do you see as the main driving force behind this spike in oil prices? It's not Chinese demand, is it?
Yeah, I think. Look, I think let me just, in the name of full disclosure, say that I've had a long-term bull bet on oil since 2018 in the form of a private equity. Right.
Okay.
It's an illiquid position, but I put it on as a very long-term, essentially 10-year bet on oil. That said, starting in April of 22 last year, I became short-term bearish on oil for all of these macro reasons. And despite the recent rip in commodity prices, I think that it's not going to hold, unfortunately, and that's speaking against my own long-term interest. I have been starting to hedge through XOP options, but to me, if you look at the rest of the commodities, industrial commodities, copper, aluminum, steel, for instance, they're all breaking down. They're all on levels of key support and almost directly, sort of inversely proportional to dollar yuan, right? And a while ago, I coined this term. I call it the Chinese yuan oil doom loop. And my issue is that because I see this tremendous headwind to the yuan, I see that as very, very deflationary for the entire world, but in particular to pro-cyclical commodities, because look, it's a dollar-based commodity. You're going to see demand destruction. You're seeing it happen in Asia with Japan and China. I think that this commodity strength has to do with two things. One is that we're in a seasonally strong period to begin with. Number one, that's about to ebb. It usually ebbs in the fall and then picks back up probably in December. But what I fear is that by the time you see the seasonals rebound again in December, is the same time when we're, at least in the US, will start to finally see some cracks in unemployment. So I'm, in the short term, I'm not bullish on oil. I think that in my mind, first of all, the risk reward is all screwed up. I think that because OPEC Plus has already cut 3 times, and to bring oil to currently where it is, they've run out of bullets because Saudis are only at 9 million barrels per day now from their peak of around, call it 12. There's a lot of forward spare capacity in the system right now. And so to me, I think that precludes a runaway oil price, even if the macroeconomy was very vibrant. It is not. I think that a lot of the Chinese demand numbers you see have to do with them stockpiling. Now, there's a lot of opacity around exactly how much product capacity they have and how much SPR capacity they have. They have been stocking up, and people like Kyle Bass would say that that's because they're planning for war, imminent invasion, something like that. It's all possible, right? It's certainly all possible, but there are limits to how much they're going to of that stocking is going to continue, and certainly at current prices, I would say that you're going to see that demand elasticity start to kick in as well, right? So on the upside, the reason why I think the risk reward for oil is not good here is that the upside, given the forward spare capacity prevents a flyaway scenario. But the downside is, what you can see in 1998. I've warned a couple of times since last summer that I feel like some of these currency crises can take a long time to metastasize. And I note that the first wave of currency devaluations in the summer of 1997 preceded the Russian default and the blow up of LTCM by almost 18 months.
Yeah.
Right. So we first saw dollar wrecking ball 1.0 essentially during 2022, during all of 2022, and we're getting to that point where you're starting to see a resurgence, and the only thing, quite frankly, that's holding the DXY back. DXY is currently at 103.33. The only thing that's really holding the DXY back, as we all know, is really the euro, because the dollar wrecking ball has been swinging wildly in Asia already, with dollar yen at 146 and Chinese yuan at 730. So I think it's a scary time to be in pro-cyclicals right now. That's my opinion.
If you look at the potential for a response from the CCP, either via a fiscal package, via release of strategic petroleum reserves, or something third. What do you make of this list of scenarios? What's the most likely scenario seen from your perspective when it comes to the reaction from the Chinese authorities to this situation?
It's interesting, because I actually think that they need to unleash both monetary and fiscal bazookas. But whether it's ideological, sort of dogma against doing what the West has done in terms of our COVID response, or whether it's a sort of deer in the headlights situation, I'm not sure. But their response has been very, very tepid. And what I fear for China, and I guess by implication the world, is that the longer they take to combat what looks more and more like a deflationary spiral, the more costly the eventual response is going to be. Because if you think about it, let's take a 30,000 foot view for a second and just look at how different the responses were to COVID, just to COVID. In the US, right, we flooded the system with monetary liquidity and with fiscal stimulus to shore up and protect the consumer. And that's part of the reason why the Fed is having such a hard time getting essentially core inflation down in the US, right? We're still seeing the lingering effects of that liquidity. But if you look at China, they effectively locked down 18 months longer than we did, and offered none of that support. If anything, they went the other way, right? Because they had the 3 red lines policy to curb property speculation, which worked a little bit too well, causing Evergrande and now Country Garden. I said Countrywide. That's a Freudian slip.
Smash.
Yeah, exactly. So it's worked a little bit too well. And now I don't see them really reversing course. And so it's a weird macro environment, because the yuan's continued depreciation suggests that they are going to continue with their monetary stimulus, right? But we're just seeing it in like little trickles. And if they continue to disappoint, I think that that deflationary pulse will eventually get exported to the rest of the world. And so if you go back to what I said earlier with the Ivan Drago Fed analogy, in terms of what the Fed is going to break, I think the Fed is going to break one of two things, or both: either the US labor market or something fragile in the rest of the world, namely China. And it could very well be that this China implosion plays a big part in ultimately what allows the Fed to declare victory. It could very well be.
Yeah, Makes a lot of sense, Michael. It's been a great pleasure to discuss this interesting theme with you. We'll assess the Chinese situation on an ongoing basis in this podcast. I think
nerves.
we can rest assured that it's not the last time that we discuss the Chinese real estate market for the remainder of this year.
There's just one last point I want to make, which is, again, the scary thing here also is that I listened to this Odd Lots podcast a while ago with Richard Koo, and you probably listened to that one, right?
Yeah.
And he was comparing China's predicament with Japan's in the 1990s. And if you remember, so the big takeaway for me was that he said that in 1990, Japan's property bubble burst, but it was another 19 years before their demographics peaked. If you think about what's happening to China now, their property bubble and their demographics peaked at the same time, basically about 2 or 3 years ago. So to me, I think about when you think about cycles, right, and the superposition of cycles. In Japan's case, you had a short-term cycle going down, but they still had a long-term cycle that was still up at the time. 19 years out of phase. Now you've got China, where you've got a short-term downturn, but it's now superimposed on the long-term downturn at the same time. So, in engineering, we call that constructive interference, right? When you've got two sinusoidal cycles superimposed upon another, and it exacerbates the magnitude of the down cycle. So that, I think, is what we're seeing in China, and it's very scary because honestly, I don't think we've ever really seen that happen, at least not on this magnitude before.
No, definitely not.
Yeah, absolutely fair point.
Yeah.
Michael, if our audience wants to follow your thoughts on a running basis, where do they find you?
Well, I'm at Urban Cowboy on Twitter, and then I have a Substack, urbancowboy.com with a KAO. So.
Perfect. Thank you very much for being with us today, Michael Kao. It was a pleasure hosting you.
Super interesting.
Thanks for having me.
Back from the interview with Michael Kao, Emil, great guy, very knowledgeable around both commodities, China and the Yuan.
Definitely.
And I guess, Emil, I mean, our base case has sort of been that the 730 handle would sort of hold.
Yeah. I think the signal from letting that one break is just like too excessive for the Politburo to really accept. That's my base case, and I also think that it implicitly sort of forces them to actually do reforms internally versus actually just letting the yuan depreciate. So that's why I'm on that side of the fence.
Yeah. But given the discussion here with Michael, there are pros and cons of having such a view.
Yeah.
And I guess when we look at current commodity trends, current portfolio trends of ours, it is safe to say that we hope that this 730 handle holds.
Yeah.
It's been a mixed bag of goodies to be long energy, commodities, etc., with China suffering.
Yeah.
Especially the part of the bet related to basic materials, industrial metals, etc., suffered big time, alongside this focus on country garden, etc., Emil.
Yeah.
So is it a necessity for the commodity view that China rebounds here?
I would at least say, yes, that it rebounds to an extent. You don't need an overheating stimulus package, but yes, you need some resilience from China. Absolutely. But I don't think they will necessarily deliver, the large scale stimulus, but we will see something. I hope.
Yeah. So. We ought to remember they delivered 4 trillion in 2008, post Lehman, right?
Yeah.
So they are capable of doing it.
Most definitely. Yeah.
But
a lot of debt to struggle with internally.
Yeah, debt levels are well at another planet now compared to 2008. Emil, when we talk about the oil market and the Chinese link, I find it interesting that the oil price has sort of managed to move up without China firing on all cylinders. So is that a supply side story?
Partially,
Yeah.
yes. I think it's like supply momentum on oil is definitely strong at the moment. It's constraining it, right?
Mm.
So yeah, and another part is which is a bit of a black box, the reserves in
In China?
Yeah.
God knows.
Yeah. So we might see if they really start to refill the stores and what have you. Then you can see a decent upside short term. Doubt it, but it's
So
a possibility.
let me don my tinfoil hat for a
Yeah,
second
yeah.
here.
By all means.
I am.
That's why we're here.
No one knows whether the Chinese strategic petroleum reserve is full or not. No one knows.
They do.
Yeah, of course. But
yeah,
we don't,
No.
at least.
Nope.
No one knows that it's better than me, right? My point here is that the available proxies, so, for example, inventories at harbors, retail gasoline inventories, they're declining. And I would be surprised if the trend was the opposite in the SPR.
Yeah.
Even if a retail gasoline inventory has nothing to do with the SPR.
Yeah.
But they're, of course, correlated from a demand perspective.
Yeah.
And especially now that we've seen a pickup in the oil price, I would be very surprised if they didn't sneak out some barrels of oil out there. But I don't know.
No, but I think it sort of speaks into if you're trading China at this point. Take for instance our China real estate position, which has taken a lot of beating, right? What is it essentially you buy here? You're basically long a call of policy intervention.
Yeah.
And I think that dynamic spills over into the energy market right now. That's why we're all focused on China, right? It's really about what happens in Beijing.
Yeah, I mean, let's assume that they sort of turned back time to July 2020 and rolled back the 3 Red Lines initiative.
Oh yeah.
Then I guess our Chinese real estate position would gain 100% in a month or so.
Yeah.
Given how bombed out the sentiment is.
Yeah. At the bottom.
I at least wouldn't rule that out in case of massive policy intervention. But yeah, I think we'll leave it at that for this week, Emil. It's a tricky juncture, and everything is essentially a bet on the Politburo.
Yeah.
I prefer the casino to this, to be honest. But let's end on a slightly more hilarious note, at least.
Right.
I don't know whether it's a positive note. I found a clip with a couple of stop oil activists making a major and hilarious mistake.
Climate activists head for an oil terminal on the banks of the Thames in Essex. They are protesters from the controversial Just Stop Oil group. The aim, to break in and disrupt operations.
Get out, mate, come on.
But security is ready. Undeterred, the rest try another route. Eventually, some glue themselves to the wall and are arrested.
Our demand is literally just to stop all new licensing and production of fossil fuels. We're not asking for everything to be halted immediately. We know that's not possible. But we just got to stop it now because it's just only going to get so much worse.
Earlier in the day, another group stopped tankers on a busy A road, infuriating drivers. One slows to talk, and activists climb on top.
Well, the police will hopefully be here soon, and then you can be on your way in like maybe 2 hours.
2 hours?
They are unapologetic.
We have tried with marches, we've tried with petitions. They have not listened to us. This has to be the next step, and we need to take opportunity of the very small window that we have.
Several activists have blocked a road nearby.
Our
We know that the vast majority of the British public really care about climate change, but a lot of them are very angry at your methods.
Absolutely. If I was in my car stuck in traffic for this, I'd be cross too. But I have 5 children and I need to know that there's a future for them.
How long are you going to stay here for?
Just Stop Oil has been doing this around the country for weeks now. Some local fuel
Here comes
shortages
the good
have
part,
been
Emil, now.
reported, but it's the inconvenience that's too much for some.
They stopped all our work. Do you know how much that costs us?
What are they achieving?
Well, what they're saying is they want maximum disruption to stop the government extracting oil and gas.
Yeah, but that's cooking oil.
They're mental. They're just holding the country to ransom.
The Home Secretary, Priti Patel, has called these activists selfish, fanatical and frankly dangerous. And the Labour Party has said there should be an immediate nationwide injunction on their protests.
I don't think we could end on a better note than this. Simply just tremendous.
Brilliant.
I think we will leave it at that for this week.
Stay safe out there.
If you want more of our research at steadofresearch.com, you can use the coupon code MACRO30, MACRO30, to get 30% off your subscription at steadofresearch.com. Thank you very much for tuning in to the Macro Sunday podcast again this Sunday. We'll see you again in a week from now.
Sometimes may be good, sometimes may be shit.